Today we're going to be discussing the art and science of chart patterns. Now the price data, which is used to construct a chart, can't be argued. That's the science behind it. But how we view or interpret that chart pattern, of course, can widely vary depending on our bias. So when we talk about picking your favorite chart pattern, it's not really up to us choosing something. It's our bias dictating how we view that pattern. So we're going to do this initially by going through trading boxes. And the reason is because of all the charts that I share on X, the one that yields the most feedback, both positive and negative, are trading boxes. And so trading boxes in and of itself is a strategy that is both an art and science. So let's start with the art part first. So when we talk about an art, it just means that it's subjective, right? We have our own opinions on it. And so there are rules, of course, to follow with any type of discipline, whether it's technical analysis, fundamental, quant, so forth and so on. But as humans, right, we have the ability to form our own opinions. And that, from a trading box perspective, is identifying where those trading boxes lie, or the boundaries of which to use, both locate and draw the boxes themselves. So we've been through this many times. We know that trading boxes are just a way to classify trading ranges, and we have a breakout from a box. We know the market is moving higher. And from this chart, clearly the market has been in an uptrend, and this can be easily seen by the number of blue boxes or trading box breakouts we've seen over that time frame. This chart is just a result of how I believe these trading ranges set up. Someone else could look at it completely differently, but along the way, what can't be argued? That we've had box breakouts more often than not, and we have trading box breakouts that outnumber trading box breakdowns. What do we have? An uptrend, right? It's just a matter of understanding that concept first instead of arguing about where the boundaries should go, right? At least that's my opinion. And so that takes us to what's happened over the last few months, where after the spike post the presidential election, we made new highs again. But from that point, for the most part, the S&P 500 is net flat. And so, yes, we had a breakdown from the December trading range, and then a much bigger trading range with a false breakdown, and then with a slingshot higher over those final 2 weeks of the month, we had a breakout. And now from that point, another trading box is formed. Now, the reason why I take issue potentially with this version of it is because, as you can see, one major difference between what's been happening recently compared to the other trading box breakouts here is that when we had those box breakouts, almost every time, the breakout had an immediate follow through, which allowed the next box to form a good deal above the previous one, right? But right now, most of this action has been taking place within the upper half of the previous box. And so the question is, should we look at this differently? Should we do a better job of classifying the trading action from a much broader perspective? And if we do that, we can account for the last 3 months of back and forth trading with one big box, which looks more like a rectangle. More importantly, this box is much bigger than anything we've seen over the last year. So the question is, are we really comparing apples to apples? And if not, maybe we should look at the previous number of months as well in an entirely different point of view. And if we do that, then this entire period can be classified with just 3 big trading boxes, including the most recent one. And this makes a lot of sense as well, because number one, we start each one of these right after the S&P 500 came off the most recent high. And as it continued, of course, the lower part being where the low just was, and then the breakout above each one of these. Now, this looks at the most volatile weeks and months that we've seen over the last year, and also the best breakouts as well from those boxes, which then led to pretty substantial and noticeable upside follow through, which of course leads us to where we are right now with this potential box breakout being the third one. Just like the other ones had, it will be at new all-time highs. And if this looks familiar, it should, because we're looking at this chart a number of times as well, looking at this last period and saying that if we do get that big box breakout and the number of 1% moves start to lessen, then it could very well resemble the following months after coming back from the March, April, May period, and then of course from July, August, September, leading to, once more, multiple months of consistent, more trustworthy, non-volatile trading action. That is what we've seen over and over again over the last 2+ years now. Now, how do we view trading boxes as a science? Well, as we know, there are many tools available to us nowadays, whether it's AI-based or something else, in terms of being able to utilize an indicator that can give us the result that we want. So TradingView, of course, is one of these offerings that does this. And in fact, if you go into their system and type in trading box as one of the indicators, or Darvis box in particular, we can get a number of different variations which shows trading boxes, again, derived directly from their system. And I did that, and for the S&P 500, and this is what it came back with. And again, this isn't surprising. It actually is very close to what we had been doing all along the way. As a comparative basis, you can see this is, again, the same chart we used in chart 1 here. We have a few more listed, but for the most part, the major trading boxes are pretty much the same. Pretty proud to say that we matched what a computer has been doing. Now, the question is, of course, should we trust it? And so I wanted to look at a few other indices, one in particular, because as we know, the S&P 500 looks a certain way, being market cap related, and with so many of the bigger names having an influence on it. So the NDX, of course, was a good example of which to choose. And we can see that it looks a lot different in terms of the boxes that the system has chosen, or the science as to telling us of what trading boxes to trust. So again, side by side, we can see that for the NDX, it looks at the entire period from the July high, August low, all the way to right before the market broke out post the election. Whereas for the S&P 500, we had 4 different trading boxes in there where the NDX had 1. And if you look at all of this, it doesn't look too different, right? This could be the same box here. We can classify this whole thing as a box the same way that they have for the S&P 500. And then again, any one of these small consolidation areas could be as well, where the period right after that looks pretty similar, right? 3 trading boxes. The point being is that whether we utilize this from a technology-assisted way or from the naked eye, right? It's about interpreting what makes sense to us. Another part of the art of technical analysis or patterns is we don't have to pay attention to trading boxes at all if it doesn't make sense to us, right? We can look at classical patterns as well, which is what we actually do much more often than utilizing the box strategy. And so from that angle, what does this look like? Right? These are the 3 bullish patterns we keep on profiling, the ones that worked out. Again, the breakout from June and September, and potentially one more here. And so not surprising, it utilizes the same price action as we just talked about for the trading boxes. So again, this is subjective. This is an art. What looks good to you is what you should use. And so from a live pattern perspective then, just to update us, the breakout through the falling wedge pattern continues to be in play. It's been tested almost every time we talk about it, but it continues to hold. That means that the 62.90 target continues to be in play as well. And of course, the breakout from September of 61.80 has been live, for a number of months now. But the potential pattern that we're looking at, the 64.25 would-be target, would be triggered if we finally get a decisive break and close above that 6,100 area. Again, is this art or is this science? Well, it's art in terms of what I'm looking at, but when we get the breakout, the measure move is a science. Whether we want to believe it or not is something we have to accept if, in fact, we do get the breakout. Now, from a weekly perspective, same type of thing. We've been looking at this channel for a long time. This is in log scale, right? And this is our way of viewing it, but it's no denying the fact that every time the S&Ps come back up to this upper line, it is either slowed down or sold off. And at the same time, since the 2023 October low here, anytime that the S&P 500 has come back down to the middle of this pattern, there's been a demand, right? And so how we look at this is, well, this is a trend. This is a behavior we have to respect until it changes. Now, someone else could look at this and say, well, we can't ignore this low here. It's much better to draw the line connecting there. And that's what this would look like. Starting with the same point here, the October 2022 low, connecting the October 2023 low, the S&P is way above that, but the action from the October 2023 low here, giving us an additional trading range, which has been holding as well. Which trading channel makes sense to you? That's the most important part. So we reviewed trading boxes, we reviewed classical patterns, we reviewed weekly trading channels. Each one of the charts we looked at is important. We should never ignore them, but we should always utilize the version that makes sense to us to both help us manage risk and, of course, and create some alpha. That's what we have for today. Check out these videos and subscribe, and talk to you next time. Thank you.